Over the last 2 years, Alibaba's stock has essentially gone nowhere. That's despite it being one of the cheapest stocks around. The company has a current market value of 198 billion US dollars, but it's also got 34 billion of cash on its balance sheet and 75 billion of investments. Subtract 24 billion of debt and the enterprise value comes to 112 billion. Considering Alibaba has reported 22 billion of free cash flow over the last 12 months and almost 27 billion of ebitda, the stock is valued at only 5 times free cash flow, and the enterprise value to ebitda ratio is even lower. That valuation has sparked interest from a number of high-profile investors. Filings indicate that David Tepper, Burry and Howard Marks all own the stock. But it's worth understanding why Alibaba's stock is so cheap in the first place. As noted in my previous Alibaba video, the company has a variable interest entity structure which contains certain risks to investors, such as not providing direct ownership of the company. This grey legal area surrounding the VIE structure is enough to put some investors off entirely. Combine that with geopolitical tensions and a heavy-handed Chinese Communist Party, and it's easy to see why markets punish the stock. Aside from those risks, Alibaba is not performing as well as it has in the past. Revenue did grow 8% last year, but inside that growth are some worrying trends. For example, Alibaba's core commerce business is clearly losing share. Revenue rose just 4% in the March quarter. By comparison, JD.com revenues grew 7%, and Pinduoduo's revenue soared 131%. Even Alibaba's cloud business is not living up to expectations, growing just 3%. Profit margins are weakening too. Net income margins of 8.5% are well below the 26% margins reported in 2018. The question for investors is whether or not all of these factors are big enough to cover the dirt cheap valuation. That's especially true now that Alibaba is returning cash directly to investors via dividends and share buybacks. Meanwhile, growth in artificial intelligence is something to watch. Management said on the Q4 earnings call that revenues related to AI more than tripled year over year. However, that revenue is coming off a low base, and it will be some time before it moves the needle for Alibaba's stock. So the risk is that Alibaba fails to grow its business and the stock continues to go nowhere. In the meantime, there are surely better investing opportunities to be found elsewhere. But these are my personal opinions, not financial advice, and I hold no position in Alibaba. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.